What if I told you there's a stock trading under $7 right now, sitting on top of over 160 million shares sold short that could either rocket higher in one of the most violent gamma squeezes of the season or completely implode under a wave of shareholder dilution? Sounds almost too dramatic to be true, right? Well, hey everyone, welcome back to Smart Stock Sam, the channel where we cut through the market noise and hand you the raw mechanics driving today's biggest trades. Today we're doing a full deep dive on SoundHound AI, ticker symbol SOUN, and honestly, by the time we're done, you might completely change your mind about buying this stock right now, because there is one hidden number buried in the data that could flip this entire setup on its head. We're going to walk through the price action, the merger mechanics, the technical chart, the institutional money flow, and the options battlefield building around this Friday's expiration. Stick with me through this whole video because I'm going to give you the exact entry zone, the exact stop loss, and the exact profit targets that traders are watching right now. And by the end, you'll understand exactly why some investors are sprinting toward this stock, while insiders inside the company are quietly running the other way. Let's get into it. Let's start with where this stock actually sits today. SoundHound just closed at $6.96, posting a solid daily gain of 6.26%, which works out to a jump of 41 cents in a single session. Now, a 6% pop looks exciting on the surface, but let's zoom out for a second, because context matters here. Year to date, this stock has been hammered, down somewhere between 31% and 38%, and it is still miles away from its 52-week high of $22.17. So why the sudden heartbeat? Two catalysts are driving this move: the recent live-person merger integration and the launch of their new Oasis agentic AI platform. But here's the twist. The real story isn't even the AI technology itself. It's the market mechanics quietly building underneath the surface. We're looking at a jaw-dropping 40.93% short interest, combined with a rapidly approaching $7 merger floor that is acting like a magnet for price action. So what's my early read? This is shaping up to be a high-risk, high-reward, short-term momentum setup, one where extreme short interest and merger mechanics have completely decoupled the near-term price from the company's actual long-term fundamentals. Could this become one of the most talked-about squeeze setups of the summer? Let's keep digging. Let's break down exactly what's fueling this frenzy. SoundHound just announced a $43 million all-stock acquisition of LivePerson. It's a major strategic move, merging SoundHound's voice AI with LivePerson's text AI to build an omni-channel powerhouse, targeting a combined revenue between $350 million and $400 million by 2027. On top of that, they've rolled out Oasis, a brand new self-learning agentic AI platform, and they aren't just building software behind closed doors, they're expanding aggressively in the real world too. They've locked in multi-year renewals across the telecom and energy sectors, and they're rolling their AI voice agents out across 2,600 Casey's convenience stores nationwide. To fuel this global AI push even further, they just opened a brand new technology and innovation hub in Bengaluru, India. On paper, this looks like a textbook expansion phase for an ambitious tech company hungry for growth. But here's the question worth asking. What happens when you look at how they're actually paying for all of this? Because that's where things get interesting. This is the single most important piece of data in this entire video. So pay close attention. The 10-day VWAP collar. Because the LivePerson deal was structured as an all-stock transaction, SoundHound had to set a price boundary to determine exactly how many shares they'd hand over. That collar sits between $7 and $12. Here's why this matters to you as a trader or investor. $7 is the line in the sand. Defending that $7 level protects the company's entire equity structure. But if the stock dips and stays below $7, it slides straight into what's called the maximum dilution zone. If that happens, SoundHound is forced to issue a dramatically larger number of shares to cover that $43 million deal, on top of the staggering $261 million in debt restructuring they're inheriting from LivePerson. So think about that for a second. $7 isn't just a random chart level, it's a hard corporate and institutional floor. It's created a magnetic battleground because everyone in the market knows exactly what happens if that floor breaks. Could this actually be the cleanest support level you'll see all year? Let's check the charts and find out. Let's zoom into the technical landscape, with the price currently hovering just below that crucial floor at $6.96. From a short-term perspective, the bulls are pushing hard. The stock is currently trading above its 5-day moving average of $6.92, its 20-day moving average of $6.78, and its 50-day moving average of $6.52. That's a clear sign of near-term strength, and it gives us solid support pivots in the $6.60 to $6.79 range, specifically around the S3 level. But looking upward, there's a formidable ceiling waiting. The 200-day moving average sits at $7.34, acting as major overhead resistance, alongside an R3 pivot at $7.06. Now let's check momentum. The 14-day RSI sits at 60.67, and the MACD reads 0.116, both flashing solid buy signals. But here's where you need to be careful. The stochastic RSI is sitting at 78.67, firmly flashing an overbought warning. The rubber band on this stock is stretched incredibly tight right now. So who's actually controlling this stock behind the scenes? Let's follow the big money. When we look at institutional ownership, big money controls the majority of this company, holding 54.38% of total shares outstanding. And lately, we've seen some massive, wildly polarizing moves. The Vanguard Group just backed up the truck, adding over 43 million shares, pushing their total stake up to 11.58%. Goldman Sachs followed right behind them, adding over 3.4 million shares to their books. But on the flip side, Morgan Stanley trimmed their position by roughly 1.9 million shares. So which side is right? Despite this mixed institutional rebalancing, Wall Street's analyst target trajectory remains incredibly bullish. The current consensus price target sits between $12.75 and $14.93. From today's price, near $7, that implies a jaw-dropping potential upside of more than 80%, and it's earning a moderate to strong buy rating across Wall Street desks. Sounds like a slam dunk, doesn't it? But before you get too excited, there's one piece of this puzzle that could completely change your perspective. Let's address the fundamental friction pulling this stock in two completely different directions. First, the valuation disconnect is severe. SoundHound currently trades at a price-to-sales ratio between 15.2 times and 16.6 times revenue. To put that into perspective, the average software industry price-to-sales ratio sits at around 3.5 times. That means you're paying an enormous premium for this stock, one that's heavily overvalued by traditional metrics. Add in their high cash burn rate and the assumption of that $261 million in live-person debt, and the balance sheet starts to look fragile fast. But here's the real red flag, the one that should make you pause before clicking buy. Insider bearishness. Over the past 6 months, company insiders have executed 13 separate sales and exactly 0 purchases. Just 17 days ago, CEO Kevin Mohajer sold 251,050 shares. And 12 days ago, COO Michael Zagorsek unloaded 117,962 shares of his own stock. When the top executives of a company are dumping shares right before a major merger closes, doesn't that make you want to ask why? Let's reconcile that against everything else we've just covered. This is where we bring everything together, because there are two completely different games being played on this stock right now. If you're a long-term value investor, your honest takeaway here should be to avoid or hold. Why? Because of that 15 times premium valuation, the unproven integration synergies with LivePerson, the aggressive insider selling we just covered, and the very real structural debt and dilution risks sitting on the balance sheet. Your smartest move is to sit on your hands, stay patient, and wait to monitor post-merger revenue retention and actual profitability before ever committing new capital. But if you're a short-term momentum trader, the story flips completely, and your thesis becomes a high-conviction buy. Why? Because of the technical moving average breakouts we just walked through, the insane 41% short float, the massive options gamma squeeze potential building underneath the surface, and the near guarantee of institutional defense around that VWAP collar floor. Your action plan, if you fall into this camp, is to exploit this high-probability setup heading into the July 10th expiration. So which trader are you? Let's dig into the exact mechanics that are making this squeeze possible in the first place. Here's exactly why momentum traders are salivating over this setup. SoundHound currently has an astronomical 40.93% of its entire float sold short. That translates to a staggering 160,950,000 shares that have been borrowed and sold by bears betting this company will fail. The velocity metric here, the days to cover ratio, sits at 7.45. In plain English, that means it would take short sellers more than 7 full trading days of constant buying just to close out their positions. On top of that, the cost of holding these short positions is brutal, with an 11.07% borrow fee rate eating into their returns every single day. The core insight here is simple. SoundHound is currently one of the most heavily shorted stocks on all of Wall Street. That extreme short float primes this stock for a violent short squeeze if the bulls can simply push price above key technical resistance and force those bears into a panic. Could this actually be one of those rare textbook squeeze setups? Let's look at what's happening in the options market, because that's where the real fireworks are building. Welcome to the options battleground for the July 10th expiration. Options activity recently spiked to 1.8 times normal volume, with over 87,000 total contracts trading hands in a single day, and an overwhelming 85.7% of those were call options. Now, look at the open interest. The $7 and $7.50 strike prices are literal brick walls. At the $7 strike, there are 6,117 calls sitting against only 1,637 puts. Move up to the $7.50 strike and you'll find 5,145 calls against a measly 700 puts. Here's the insight that should get your attention. Retail and institutional bulls are aggressively weaponizing these call options. Why does that matter? Because when traders buy a massive amount of out-of-the-money calls, it forces the market makers, the ones actually writing these contracts, into something called delta hedging. They are legally required to go out into the open market and buy the underlying stock to protect their own books. Is it possible this single mechanic alone could be enough to send this stock flying? When you combine it with everything else we've covered, the picture becomes impossible to ignore. We are witnessing a genuine catalyst convergence, 3 distinct powerful forces colliding at the exact same time to create the conditions for explosive volatility, most likely in the form of a gamma squeeze. Force number 1, that massive 40.93% short float, leaves bears trapped and sweating in their positions. Force number 2, the heavy call buying at the $7 and $7.50 strikes, forces market makers to continuously buy the underlying stock just to stay hedged. And force number 3, that $7 VWAP collar, creates a genuine corporate and institutional imperative to defend this price floor and avoid triggering equity dilution. 3 separate forces, all pointed at the exact same target. That's what creates this magnetic battleground setup. Together, these 3 vectors virtually guarantee heavy volume and intense directional pressure heading into this Friday, July 10th. So how do we actually trade this? Let's map out the exact playbook. Here's the actionable tactical trade setup running from July 7th through the July 10th expiration. Our primary objective here is to capture the gamma and short squeeze potential building from this option's open interest and the ongoing VWAP defense. Your entry zone sits between $6.75 and $6.95. You'll want to trigger this entry near the pivot support at $6.88, or alternatively, wait for a confirmed volume breakout above that $7 wall. Your primary support is locked in between $6.50 and $6.60. That zone is heavily defended by the 50-day moving average at $6.52, plus a massive wall of put option open interest acting almost like a trampoline underneath price. But listen closely here, because this part matters most. Your stop loss must be set at $6.45, and this requires strict discipline. If price falls below $6.45, it breaks the 50-day moving average, and the entire squeeze thesis is invalidated. Make no mistake, the risk profile on this specific trade is exceptionally high. So if our entry triggers and momentum kicks in, where exactly should you be looking to take profit? Let's map out the tactical price ladder and our profit targets. Right now, we're sitting in the action zone, hovering around $6.96. If momentum pushes us upward, target 1 sits at $7.34, right where we clear that heavy 200-day moving average resistance. If we blast straight through that level, target 2 comes in at $7.50, the major call option wall where you can expect a serious spike in volatility as contracts move in the money. And if a true unbridled short squeeze actually triggers, target 3 sits at $8, a major psychological resistance level and the secondary open interest cluster. But I'll say it again, because it matters. Your stop-loss threshold is a hard line at $6.45. If price drops below the 50-day moving average, the squeeze thesis fails, and you need to cut your loss immediately to protect your capital. Now, before you get too excited about any of these targets, we need to talk honestly about the risk sitting on the other side of this trade. Let's ground all of this with a final reality check. The opportunity here is genuinely compelling. Short-term price action is completely decoupled from standard valuation metrics right now and extreme market mechanics, specifically that 40.93% short interest and the $7 merger collar battleground, are set to strictly govern price action through this Friday. But on the risk side, you need to understand exactly what's at stake. If that $6.45 support level breaks, the short squeeze thesis fails completely, and the equity dilution risk tied to the live person merger skyrockets immediately. For anyone deploying long-term capital, the smart move is to wait on the sidelines for post-merger integration data and real, tangible profitability metrics before jumping in. For short-term traders, tight, emotionless risk management isn't optional here, it's mandatory. So, is this the kind of high-stakes setup you'd actually consider trading? Before you make that call, I need to leave you with something important. As always, everything covered in this video is for informational and educational purposes only, and none of it should be taken as financial, investment, or trading advice. Trading equities and options carries a significant risk of loss, and the tactical setup we walk through today is hypothetical, built entirely around specific, highly time-sensitive market mechanics that can change in an instant. Past performance is never a guarantee of future results, so please do your own research, manage your risk carefully, and never risk more than you can afford to lose. Now, before you go, I want to hear from you. Here's my question for the comment section. If SoundHound closes below $7 by Friday, are you watching for this squeeze setup to fail, or do you think institutional buyers step in and defend that floor no matter what? Drop your answer down below. I read every single comment, and I'll be replying to as many of you as I can. If this breakdown helped you see SOUN in a completely different light, do me a favor and smash that like button. It genuinely helps this channel grow and helps more traders find this research. And if you haven't already, hit subscribe and turn on notifications because we cover setups exactly like this one every single week here on Smart Stock Sam. If you want to go a step further and directly support the channel, you can send a super thanks using YouTube's built-in support feature right below this video. Every single one genuinely helps us keep producing research like this for free. And if you're serious about leveling up your trading and investing game, come join our channel membership. Members get early access to trade setups before they ever go public, priority replies to their questions, and custom analysis built specifically around the stocks they're watching. If you want to move faster and think sharper than the crowd, come be part of the community. Thanks for watching. I'll see you in the next one.